Welcome back to the Phil Bach podcast. Are you guys ready to nerd out on REITs? I think it's long past overdue that we did. As a reminder, this podcast explores a variety of ideas, but if you're interested in a deep dive on real estate REITs, how to invest in them, check out our weekly spaces on Twitter with my partner, Hunter Hopcroft, who's at rhunterh. You can find the weekly spaces there. We're going to be bringing those over to a podcast as well and bringing Randy onto a spaces. But for now, I am extremely excited about this conversation. We've got the guy, if you want to talk about real estate or REITs investing, Dr. Randall Zisler. Randy is the former head of research at Goldman Sachs, as well as Nomura Securities. He's a PhD. He's been a longtime professor at Princeton. He's raised over $6 billion in real estate deals. He's written over 100 academic papers, some of which are among the most influential papers in real estate investing. In fact, I talk about this the first time I saw Randy's name was when I was studying for the Kaya, and his paper was on the curriculum for the Kaya exam. He is also a general badass. So, Randy, thank you for joining the podcast.
Well, thank you. It's a real pleasure. I think we're two peas in the pod.
In many ways, but not in every way. I can't boast quite your academic pedigree. I wish I could. But
I was over subsidized.
So I want to start here. In a recent investor letter that I sent out at Armada, I talked about the work of our lives and what is the work of our lives. And I included something from you. We had talked about it. And I said, what would the work of your life look like? And he said, you'd like to look back and say that you had a significant impact on the allocation of capital and how investors think about the market. And you added a profound impact. Can you explain that?
Sure. It even goes beyond that. I think that, in your last days on Earth, if you have a moment to think about it, from my perspective, I certainly want to ruminate and be thankful for my family and the many mentors. And, the fact that I always like to tell people, when they introduce me at large conferences, that I really won genetic roulette. I always tell people I didn't select my parents. I didn't ask to be born a white guy in the middle of the 20th century, a male in the United States, which generally respected property rights. And so all of that was out of my hands. And I like to remind that to audiences that are well populated by people with prestigious degrees. And I try to remind them that there's excellence everywhere. And so what I've tried to do all my life is push myself and surround myself with inspiring people like you, Phil, that make me work harder. And I've always been fascinated with being the one in the room who always wants to find the deeper structure. And I was like that as a kid. I didn't play cops and robbers. Well, what I liked to do was build tunnels and collect insects. And I was always curious. And so I have boundless curiosity, and my wonderful wife and I have tried to inspire our children and our grandchildren in the same way. Those are very important. I do economics, I do math, and I advise investors. But, I just gave you a glimpse of some of the points that are even more fundamental to me.
You talk a lot about the mythology of real estate. What does that mean?
Real estate is, for the most part, very much unlike science. In many respects, it's kind of like a religion. The difference between a science and a religion is that a science is evidence-based. And you are encouraged as a young junior professor, which I was at Princeton, to write papers that challenge the received wisdom. And if you can topple one of the greats, then you're on your way to maybe a Nobel Prize. And by the way, one of my classmates in the PhD program at Princeton actually did get the Nobel. And he wanted to know when I'm going to get mine in real estate. And I think I told him I'm going to be waiting a while. But,
hopefully not too long when we get our paper out.
we'll see. It gets back to the fact that, real estate as practiced is more of a religion than a science. And it shouldn't be. It needs to be more evidence-based. There needs to be fewer stories. But real estate is something that is sold. It's very much unlike stocks and bonds. But even there, I worked with some of the best bond salesmen and stock salesmen at Goldman, and what they wanted to know in the research is what's the best story that's going to get me more clients. And my approach was I always wanted to do stuff that had practical implications, but I wanted to cut through the mythology, and I wanted to be somebody who, again, showed the deeper structure using science and showed people that, people could be more successful in their investing. And so part of it is really understanding what people do and why a lot of it is counterproductive or just simply specious. For example, in real estate, a lot of people still think that real estate's an inflation hedge. And I've written papers on it. You've seen some of them, and it's not in the short or medium term, maybe in the long term. But people still believe that. And one very well-known investor, a globally recognized investor, one time said, "Well, if real estate's not an inflation hedge, why invest in real estate?" I said, "Well, there are lots of reasons, and to think of real estate as one asset, I think is wrong. It's really a kind of a portfolio, a cornucopia, if you will, of risk factors. And what you're really doing is you're being compensated for taking on certain risk. So that's a different approach. And really what I've done over the years, I've tried to take fixed income, portfolio theory, derivatives, and all these other areas, corporate finance, and apply it to real estate. And a lot of the work I've done is what we call stochastic. And by the way, for the audience, that's not a dirty word. It just simply means uncertain. And most of the analysis that's done in the real estate industry, particularly lease by lease analysis of buildings to value buildings, is all deterministic. When in fact, these buildings are replete with options. And if you look, for example, at exchange traded REITs, you look at the underlying assets, the REITs, they're replete with options, and so are the underlying properties. So what I tried to do is to apply that, and I get very, very interesting results that really flies in the face of the received wisdom. And I've been invited many times. I remember the vice chairman of Blackstone asked me to come and make a presentation to their senior managing directors, and it was supposed to be a half an hour presentation, and they were in one of their well-appointed conference rooms, and it went on for 2 hours, and it was like we had maces and blunderbusses, and we were just going back and forth debating. I eventually persuaded them. I had a presentation called 10 Easy Pieces, based on Richard Feynman, the physicist, his book, The Four Easy Pieces, and quantum mechanics. I did not talk to them about quantum mechanics, though. But they resisted it because if it got out, and I were talking to their investors, it would impair the momentum of their capital placement operation.
They accepted the idea that take a more quantitative approach rather than this mythology. Is that?
Well, they understood it, and they were all, as you can imagine, very smart. And I'm not singling out Blackstone. There are a lot of fine people there, and it's a, it's a money mint. But the fact is that they're very focused people. And the way they get paid is by raising lots of capital and investing it well, not losing the money. And what I was telling them is that there was another way to think about it. And I also argued that you could actually please your clients.
I mean, I think that's really, if you look market wide, right, and what's happening broadly in the markets, this idea, you're calling it mythology. I often talk about the same concept. I call it narratives. Which I shamelessly stole from the great Ben Hunt at Epsilon Theory. And this idea that narratives drive flows and narratives drive the markets. And you see it all over the market, more so now than ever before. You see it, of course, in crypto. You saw it with these NFTs, you saw it with the meme stocks, but also you see it with, let's say, Tesla, right? Is Tesla a car company and therefore gets a car company valuation, or is it an AI company, right? Is it, is it clean energy? Is it a bogey for, all these other things for the transition to EVs? It's not just that, it's equities themselves, right? Investing in stock market broadly, that has become very much driven by narratives, right? You're not looking at the market cap weighted funds are basically 7 stock portfolios at this point, at least to a large degree. And they can't go on forever, but the idea, certainly the narratives are that they can. It says not timing the market, it's time in the market, that these index funds are well diversified, even though they're not, that, the Fed will always have your back. And so much of investing now is, based on what you would call these mythologies, what I would call these narratives. And then you take it back to REITs, right? So now let's kind of bring it back to REITs. And I had always, in my career, I had always assumed a REIT is a REIT. They're all fungible. They're all basically, some level of beta, to the real estate market broadly.
Right.
And when around the time that I started Armada, in fact, one of the impetuses for that was discovering that no, the subsectors and geographies and different categories are actually very dispersed. And, there's two different things, right? My world is the public market REITs and how they trade. Your world is that, but it's also real estate. And real estate and REITs are very different, especially the risk profile. So, let's bring it back to that a little bit. Tell me a little bit about, how one would look at the volatility of private real estate
Sure.
versus public real estate, and how one should think about REITs in the context of real estate.
Sure. I'll tell you a bunch of things. Back in my Goldman days, I wrote a paper with Stephen Ross, who at the time was a professor at Yale. And had he lived, he would have probably gotten the Nobel Prize, as did another one of my partners at Goldman, Fisher Black, would have gotten it, but he died too early. But I was surrounded by pioneers, but the one thing that we were clearly focused on were REITs at the time. And I worked on the IPO of Rockefeller Center, and I thought the deal had a lot of, well, should I say, issues. It was very popular because people felt that they owned a piece of the rock, like owning a brick. And there was that myth, and the other myth was because the Japanese were involved, that somehow it was un-American. And I always would ask critics, we're not shipping any Rockefeller Center over to Japan. And of course, the Japanese overpaid for it. But I started to think about REITs, and I started to think about how they traded. And I also observed later on that many pension funds would include REITs as their real estate allocation. So I wrote this paper, and if you look at the return indexes for property, and a popular index is the NCREIF index, you find that there's a lot of smoothing. If you, I promised I was going to speak mathematically, but if you were to regress today's return to property on previous periods, you would find that previous periods would explain the current to some extent. And in other words, the past returns would be predictive of future returns. That is not what you have with stocks. If you look, for example, at well-traded stocks, those coefficients are essentially zero, except for the constant term, which means that your best prediction of tomorrow's stock return is today's. And Paul Samuelson, who got the Nobel, taught economics at MIT, and I was on a panel with him. It was really, I just felt so overwhelmed by him. But he said, he had an article that said that in an efficient market where assets impound news information, that's new information, quickly, instantaneously, those prices will fluctuate as if they were random. Now, we know there's causality behind it, but they fluctuate as if they were random. And therefore, from the perspective of the efficient markets hypothesis, the coefficients on that regression, except for the constant term, are zero. And we've tested that out. And I've tested it on REITs. REITs trade like small cap stocks. And if you look at the probability distribution of the returns, it's very similar to stocks. And if you do like a risk attribution analysis of the REITs, you find that real estate fundamentals have some role, but so does debt and small cap stocks. And so somebody said, well, why would I want REITs in my portfolio? I said, if you're an active trader, they can be useful because REIT prices tend to foretell what will happen with NCREIF. The REIT market tends to lead the property market. And so if you know how to interpret that, that's very useful. Secondly, is that real estate fundamentals do have some impact, the same way that the car industry has some impact on the stock price of GM. But there are lots of other things driving it. So it's inherently different. But the great thing about REITs, and I would tack on, if you will, ETFs, is that they provide if you are like a market timer. I tend to invest personally my IRA in indexes because my view about how the market impounds information. But if you are a market timer, or if you believe that you have skill in like selecting property classes, property types, or in properties, I think it's useful to have REITs in your portfolio because it helps you make tactical shifts. From a long-term perspective, they offer a different kind of exposure. I think that REITs are underestimated. Their value is underestimated, and where the REITs are extolled by real estate people, I think they're often extolled for the wrong reasons. I personally would like to see the REIT sector grow at least by 10 times. And I think it merits that. I think that in property, there are many managers, and it gets back to myths, who believe that because the market is inefficient compared to stocks, that you can pick winners. And that's not true. The market is efficiently inefficient. And that inefficiency is required to pay for the appraisals, to pay for the research, to pay for all of the infrastructure. Just like on Wall Street, you have to, it's not perfectly efficient because you have to pay for all the analysts and all the salespeople. So that's another thing. The other thing, and this again gets back to myths. I've done a lot of papers on whether property is an inflation hedge, and it's not. Real estate is not an inflation hedge. And then if you look at REITs, you get a similar result. They're not inflation hedges. But neither are. Somebody said, well, why would I want to invest in REITs? I said, then why would you want to invest in bonds? Why would you invest in stocks? You get the same result. And so people need to, the bottom line here is that people need to step back and they need to think more about fundamentals. They need to think about deep structure. They need to use your term, they need to find a different narrative and figure out how to use it and profit from it. What I like about your approach is that, you're a big advocate of, applying, finance principles to things like REITs and exchange traded REITs. And I think that exchange traded funds, and I think that's terrific. I think you're at the boundary edge of growth in this industry.
Well, I appreciate that. And we certainly have a lot that we've been working on, our heads down on the down low that we're going to be, unveiling in the next few months. But I want to bring it back. So there's really two ways that we can go here, right? Two things that I think are interesting to talk about. If we say that REITs are more correlated to stocks than they are to real estate, somewhere in there is an arbitrage. Somewhere in there is an opportunity. And how do we find that opportunity? And the other way that we can go, the other thing that I want to talk about is valuing real estate, private real estate, or let's say private equity real estate versus public equity real estate, which would be, REITs versus private REITs, listed REITs, traded REITs.
Sure.
Is dealing with the smoothing effect, right? And defining the smoothing effect and what tools can investors use to compare apples to apples. So really two different ways to go here, and kind of dealer's choice here. I'll let you pick which way you want to go in the conversation.
Okay. Well, the first thing I want to point out is that if you look at the smoothing, Professor Ross and I developed a method to undo the smoothing.
So let's start with defining it. Well, what is the smoothing effect?
The smoothing is a serial correlation. In other words, what it does is typically when a property is valued, either by an appraiser or by somebody on a trading desk doing a present discounted value analysis, they tend to be very backward looking in terms of looking at comparable sales, and these things are observed at different points in time, often with a very, very small sample size. And then based on that and a lot of other stuff and some forward looking, they come up with an estimate of rental growth rate, exit cap rate, and all that stuff. I've shown, by the way, in another paper that just about everybody's really bad at predicting what the exit cap rate will be in the 5th or even the 10th year. But that doesn't dissuade these people. So it works out to be, we would call it a third order difference equation. So what you do, you mathematically undo it, and then you wouldn't believe, voila, what you find is that the corrected risk for the property is similar to REIT risk. That was very cool. And that got a lot of
As
attention.
it should be, right? I mean, as it should be.
Yeah.
One property here, one property there, whatever package you put on top of it shouldn't impact its risk status.
Well, that's right. And if you look at the capital markets, it's not, it's not like Eastern Europe before, right after the First World War. It's not balkanized. It's highly integrated. And in fact, recently we did a paper that you saw on the quadrants. Real estate people keep referring to it as the four quadrants, and I rebel against that because I told one very well-known person, I said, if you call it the four quadrants, public and private equity and debt, I'm going to start talking about round circles. But those are real estate people. That's sort of the art of real estate. But the issue here is that the risks are similar. And why is that important? If you are going to analyze complex property that's replete with options, like the option to renew, the option to expand, the option, all that, to redevelop the excess land, all of those are call options. And the value of a call option is in the volatility, the interest rate, and the strike price. Growth doesn't matter. The growth rate, because the growth rate's already impounded in the price. That's a very important theorem that Mr. Scholes and Mr. Black taught us. But the real estate people don't understand that. So when they're valuing an option, they do it deterministically, and they figure out what the growth is along one path. Here's a good example. I was at a conference, and there were about 2,000 people in the audience, and I was their keynote speaker. So I wanted to talk to them about risk. So I said, okay, I want to ask you a question. I said, how many of you have fancy Ivy League degrees? And a bunch of hands go up. I said, I want you to keep your hands up because I want one of you people to answer the question. If I have a UK lease where I have the option in the 5th year, upward only adjusting to whatever market is, okay, I have that option. I don't have to exercise it. It's an option. However, let's say, and the market fluctuates, but let's say that everybody on the face of the earth believes that the long run rate of growth for rents are zero, absolutely zero. And I asked people with their hands still up, I said, what do you think the value of that option is? Almost to a person with fancy Ivy League degrees, they said zero. And that's wrong. So up pops a slide, and I said, this is what it looks like as a function. It was a surface as a function of time to exercise and the volatility of the market. I said, it's volatility, and the tools that you're using cannot evaluate volatility. So what you're doing is you're incurring uncompensated risk, and you're leaving value on the table, and you're either cheating yourself in the GP position or the LPs, and the LPs don't know it because you don't tell them that.
Yeah.
Well, it was kind of like viewing an execution, and but what happened was as I left and I was leaving, I had a bunch of people come to me, a flurry of cards, 20 or 30 people, and there were some investors, but you want to know, there were a bunch of managers, and the managers wanted to know how I did it, and it was simple. It was simple, but it's ignored. And why is it ignored? Because it gets in the way of their momentum. It's not that these are bad people, but it's a process. And when I don't care who you take, you can take your choice of saint and you put them in a certain process, and pursuing their own interests, they'll act in a certain way. So they could be acting individually rationally, but collectively it's irrational.
Right.
I was talking to a neighbor about something like that. It was actually on a political matter. And after I finished, they saw my wife and they said, does he have any friends? And my wife, I love her. I met her on a blind date 50 years ago. She was an opera student. I was working on my PhD. But she said, yeah, he had no dates in high school. I sure needed them. But no, this is fascinating stuff. And it's extraordinarily practical. And these tools do not require a PhD. It's simple stuff. And when you think through it, it matters. But I've talked to some really brilliant people, but then they sort of sit there and you see the wheels turning. and they're trying to figure out, well, how am I going to explain that to these investors? Because what they have to deal with is what I call is the unholy triumvirate. You have three parts. It's a conspiracy. It's a yeah. It's an hypocrisy. I don't like to use the word conspiracy these days. You have on the one hand the money managers. Number two are the investors, particularly the public pension funds. That's another topic. The unfunded public pension funds, and then the third are the pension consultants, and they work together in certain ways. It's a symbiotic relationship. And so for many of the investors, the managers kind of set the conditions of the conversation. And most of the consultants don't do very original work. They listen to the manager. I mean, it's a kind of an incestuous thing. And it's very, very hard to, it's like, it's like changing the course of a very, very large ocean liner. And so, that's what I do. And amazingly, I get hired to do all kinds of weird things. I did about 2 years ago during COVID, I raised $400 million for a very worthy guy who's structured as a REIT. They're located in New York City, and they buy grocery anchored center. And back then, nobody wanted to talk about retail. And I took it on, and we raised money from an Asian pension fund and a U.S. money manager. And then, I write papers. People want me to backtest strategies and come up with financial instruments. But, not everybody wants to hear this. But, I think there is a subset of people who do not have a huge infrastructure in doing things the same old way.
Yeah. Yeah. And that's what I've, always been attracted to about your research and about you as a person, is that you are highly pedigreed. You are from Wall Street. You've been in REITs since the beginning. You were a professor at Princeton, but you're not afraid to call bullshit. You're not afraid to, you talk a lot about how Wall Street research is always bullish, permanently bullish. You're not afraid to call bullshit when appropriate, right? And not just to call bullshit, but to do it with empirical evidence, to do it from a quantitative standpoint, which is so critical. And there are very few people who have, that pedigree, those quantitative skills, and a willingness to ruffle feathers and to challenge conventional thought. And look, when you come to conclusions that are in line with convention, you're not afraid to say so. It's not like you're trying to be contrarian, but when you come to conclusions that are not, you're unafraid to say so as well, which is a pretty rare trait. And one of the things that you've talked.
I'm not brave, but I want to interrupt you there. I'm not brave. See, I work for myself, and I'm the human resources department. That's how bad it is. I used to have a team of 10 people at Goldman that would do graphs, do regressions, everything. I made sure that I can do all of it, and I've kept up because I don't want to be dependent. But the beauty of being in my position is I don't have to worry about screwing the pooch. For example, at Goldman, when we did the Rockefeller IPO, the assumptions that they used for 10 years was in that year it was the highest rate of growth of rents in the New York office market. They used the same assumption for 10 years. Now I, down in the cave, did a really cool econometric model of the office market. And mine was very desperate because we were looking at the tax law change of 86, where, it didn't matter if you did due diligence, it was just a matter of the depreciation allowances. Remember those days? And I saw it as a very different market. And I said to one partner, I said, why would anybody do this? He said, well, they stuff it in the kids' trust fund. That was a long time ago, beyond the statute of limitations, guys. But, that's how it is. And so in my position, I can support myself and my family and my kiddies and grandkiddies. I can do very, very well because I just don't have to worry about pleasing the capital placement division. And what happens is people, the right kind of clients, really like it. And, and they pay me a lot of money to come up with these ideas. I came up with a way of recently of synthetically creating non-recourse debt using interest rate swaps. I mean, that's the kind of, stuff I think about. And I've done a lot of work applying. Well, I wrote a note to Related, and I basically said, look, when people doing complex projects like Hudson Yards, I said most developers really don't understand their cost of capital. And if they have any constraints on them at all, not just financial, but spatial, temporal constraints, the shadow price of capital is different than the external price. And so therefore your capital ration. But you don't understand it because you have all of these constraints, phasing constraints, interdependency. The developers never model that, and they get really very gullible institutional investors to invest in it. And it's structured in a way that, the developers always do well because the position of the GP is laden with options, and the more volatility there is, the more uncertainty. The IRR and the equity multiples for the developer go like that, and for the investors, the institutional investors, you might say it's less impressive. So I wrote this paper, had a lot of math, and I sent it to the CEO, and I never heard back, strangely enough. But that's what I do. And these are great tools, and it's fun, but it's very illuminating. Every time I do something like this, I say, I didn't realize that. And then I run to my wife, the opera singer, and she said the garage doors go down. But she's a very, very intelligent woman. And if I can explain it to her, then I know I can explain it to others. But it's cool stuff.
I mean, they're great tools. And look, these things might not be appreciated in a 40-year bull market, but there are market environments where I think a lot of what you've done and a lot of different metrics that are really designed to capture risk or risk management, I think are going to be all of a sudden everyone's going to dust them off and, hey, wait a minute, maybe we should look at smoothing de-smoothing returns. Maybe we should look at other risks. And there's a number of risk factors in REITs and real estate that I think are widely ignored by investors. And one of them, we've spent the last 2 months going deep into what's called in our industry MSA data, metropolitan statistical area, basically geographic data and different metrics on that. And our theory here, our thesis is that a lot of ultra high net worth investors are overly concentrated in their own geographic areas when it comes to their private real estate holdings. So we've created a tool, we're calling it MSA Edge, where we can do customized SMAs to manage people's public REIT portfolios where they're hedged again, away from their personal real estate holdings, their geographies, and the factors that contribute to them. And, it's something that you yourself have written about a lot. You've talked about MSAs. You have something about the Michelin method of picking MSAs. I thought maybe you could talk about that a little bit.
Well, I wrote this. Thank you. I've written a lot of stuff over the last year on office buildings and MSAs, but I also want to tell you, before we're finished, about a paper that I wrote in 2006 about the coming crash. I didn't get the date right, but I knew it was going to happen. And that paper could not have been written by any money manager. They would not have written it. But I wrote that. I told them at the ULI, and then they invited me back after 3 years, and half the people who were there in the first presentation were no longer in the business. But on the MSA issue, several things that are interesting. First of all, the way people underwrite MSAs, they don't really understand the interlinkages between or among the MSAs. That's number one. Number two, MSAs are like bells, carillon bells in cathedrals. They all have a natural frequency. So if you shock them with an exogenous shock, like a recessionary shock, they all react differently. And the exact nature of how they're going to react is very hard to predict. So I showed you some things recently. I looked at total returns for every MSA in the United States, and there are data for that. And then what I asked myself was, if you were to rank all the MSAs, this is like really simple stuff. This is the high school stuff. If you ranked all the MSAs, take the average in the 20-year period before the crash and rank them. And then you do the same thing for, let's say, from 2007 to 2009 or 2010. Rank those. And then after 2010, rank those. You're going to find that there's hardly any correlation among the three rankings, and very difficult to pick the winners. Now, meanwhile, you have people in Armani suits in well-appointed offices extolling their ability to forecast models. And they can. And if you look at other statistics, it's extraordinarily difficult to beat the winners with information that's publicly available. What I like about your approach, Phil, is that with use of artificial intelligence and other techniques that I think are very interesting, you're trying to focus on information that is generally not available, or is ignored, or is just misused. And that's a way to build alpha. Now, if you were to invest in the average opportunistic open-end fund, and we know who's doing those, if you were to do that, you'd find that the average alpha, which is the value added over systemic risk, the average alpha is negative 300 bips, 300 basis points, a negative 3 percentage points, which ironically enough is equal to the fees that are charged, right?
Right.
Which is ironically. But if you speak to these people, how do you pick cities? And, and then what I did is I looked at this. I used to be between Nomura and Goldman, I was a partner at Pension Consulting Alliance. So I would spend a week every month with CalPERS and testify to the investment committee. So these guys, they discovered that, hey, they were running huge deficits. It's terrible how underfunded they are. And eventually the taxpayers are going to have to pick it up. And so the treasurer of the state of California hired me to tell them how they can fix it. I said, you have 3 choices. And he brought all of his people into my office. We had around a big room. And he was the only one talking. And everybody was very, very respectful of him. And so I said, you have 3 choices, right? You can either raise taxes. And I said, since the treasurer of the state of California has political aspirations, that's probably not a good idea. The second is you can cut benefits. And that's going to be a winner too. The third is you can take the pension fund to the casino. And how do you do that? You invest in alternative assets that are opaque, that are highly structured, that are, and the purveyors of which are, very smooth talking, highly credentialed people. And what's interesting is they usually have multiple offerings. So they can't afford to be truthful. I'm not saying they're lying. I'm saying, in a sense, they're not sharing all of the truth to the extent that they even know it. They're not being that truthful because, it's one thing to impair one raise, but then you can end up impairing all the other raises. It cascades. And so there's a tight control over that. And so that's a problem. You have the pension funds who are underfunded. You have the pension consultants who are like the scribes at the feet of the Delphic Oracle. And then you have the money managers. And a lot of people who work for these pension funds and consult, well, they'd love to be a managing director at KKR or Blackstone. So, they're all there like puppies with their mouths open. And that's the institutional investing business. That's sociology of institutional investing. And so what I do is I sort of, I find, I just find the low-hanging fruit, and it's really easy. And when you point it out, it reminds me, there's a lot of resistance. It reminds me of what Sinclair Lewis said. Do not expect a man or a woman to believe something if their salary requires that they not believe it. And that is true in this business.
So how are you immune to that? I mean, if you were out there pumping out research saying, buy, everything's going up to infinity, there's no risk. I got to think that you would be doing personally, that you'd be doing a little bit better. Is that something how do you reconcile that? How do you think about that?
Well, money's not the most important thing to me in my life. I put a great value on it. With Nomura, I reported to the CEO. In 1 year, I was able to put my kids through college with no debt. And when I left Goldman, Robert Rubin, or one of the people on the management committee, they asked, well, what was it going to take to keep you here? But I was at the point where I was 200 days of the year on the road. I remember a month I was in Tokyo for 2 days, and I got on a plane. I went down to Singapore, then to London, to New York, and I'd come back. And I wasn't seeing my kids. My family was very important to me, and I wanted, I didn't want to be the organ grinder monkey, where you put them in with the new business people, and you take them out, and they give the line. And it so happens, my wife said, well, some people just don't like what you do. And I said, I don't have to be the belle of the ball. I would be happy if 5% of the industry thinks this is valuable. I don't need to be everybody's favorite. What I want to do is I want to be ethical. I want to create value, and I want to work with a handful of people where I can look back over 10 years and I can say, I helped create something important. And quite frankly, Phil, at this point, I've had enough international and national publicity. I don't need the limelight. I'm happy just to help other people, create value, launch interesting ideas. And that's sort of how I look at the business. I didn't want to be estranged from my kids. And now when I left Goldman, I started running. I couldn't get around the block. Next 2 weeks later, I could get around 2 blocks. I eventually ended up doing 3 New York marathons, and my son would ride his bike. I do 100 miles practice a week, and he would. I talked to him about everything, and he'll say to this day, and he was my partner for 10 years before he joined a firm recently in Wall Street. But he said that's when he got to know me, and I would never trade that for no matter how much money, because at some point you have to ask yourself, do you want to be the richest man in the graveyard, or do you want to set the foundations for future generations? I look at my family that way, and I look at my practice that way.
You talked in the beginning about us being like-minded, and I think what you just said really, really hits home, and hopefully a lot of people listening feel the same, and that resonates. It's not, you can keep score by maximizing how much money you make in a large organization, or you can keep score by something bigger and more heartful. And I think it takes a wise person to see that, and clearly you do it. I mean, I have here a quote from you that I have for another question that I ended up skipping over. But I mean, you had said, this is something that you've written. You said, I'm in the truth business. I work in a sector that embraces too many stories and too little science.
I speak truth to capital. I try to speak truth to capital.
And if people don't want to hear it, or if it doesn't help them tell something that their clients want to hear, that might not necessarily be true or be empirically true, you still got to be true to yourself and to your research.
See, I understand what you have to do if you're, let's say, head of research at Heitman or head of research at JLL. I understand that. That they have to pay for braces for their kids and they have to do all of that stuff. And so the way I got around it at Goldman was the market I knew was going to hell in a handbasket. So what I ended up doing was kind of more conceptual papers on risk attribution, application of derivatives, portfolio stuff, and everything. But there were parts of the firm that loved that, and I didn't ever have to hit the buzzsaw. But fortunately, I had the skills and the flexibility, and I was in the right firm. I could do that. But if you're, let's say, in a work for a large money manager, that is kind of a Johnny one note. They do one thing, they invest long in core. Well, I wrote a paper 2 years ago that was in the Wall Street Journal and the New York Times, and Bloomberg, and it was about the coming obsolescence of the office sector. This is before it really hit the fan. I was ahead of it, but nobody in real estate research wrote that. And right before the big crash, there were no papers, even though there was public data. We knew what was going on in early 2007, even 2006. I wrote my paper in 2006. There's nobody who wrote that because I collected everybody's stuff. I got quotes out of Institutional Real Estate, a magazine, of what people were saying. One of the top consultant in real estate said in middle 2007, and things the spreads were opening up. He said, any person with a wallet can make money. due diligence is for sissies.
Due diligence or sissy.
Yeah, and those are your trusted advisors, and
Yeah.
they'll get up there. One guy, who runs a huge, real estate private equity firm on the north side of Chicago, and I won't identify him. I was on a panel with the guy, and I'm talking about risk. He says risk-adjusted returns don't exist. So I said that the absence of evidence is not the proof. It's not. The absence of evidence is not evidence of absence. And I said it's convenient for you to think like that, but in the next crash, we're going to have this discussion. And he said to me, he said, "Why are you so contentious?" I said, "Because I'm interested in not fooling investors. And apparently you're so successful at raising money. The only way I know you can raise money is somebody's getting fooled." And he got very insulted. Then I got hired by more people. But seriously, and look, it's not easy running a money management firm. It's not. It's not easy threading the needle. If I were CEO of one of these firms, I have to raise money. I have to stay in business. I have to keep the teams together. Some firms where they've launched office funds, their teams have already disbanded because they know that promote is no longer in the money. So they're off to other things. So if you can keep your employees compensated, and if the promote goes to zero, they're going to go someplace else. Why? It has nothing to do with loyalty. It has to do with supporting your family or your life's ambition or buying another horse. Well, that's just the way life is.
Yeah. I mean, that's why for a firm like ours, it's so critical to have, equity and options plans for everyone. So everyone's aligned for the growth of the company as a whole.
Yeah.
But yeah, no, it's hard. I mean, last year was the hardest year. 23 was the hardest year and probably the least successful year of my career. I probably had a worse performance for myself in 2023 than any other year in my career. But here we are. It's 3 weeks into January to 24, and it's shaping up to be one of the best. So
yeah, it's and for me too. But look, you're a very unusual guy, Phil, because you have a lot of spunk and you have a lot of personal courage and integrity. And there are a lot of things that I think you could do, and you could do them well. And you've chosen to do this. You have choices. It's not like you're one of 20 or 30 grizzly partners in a state firm, and you have a certain channel, and that channel is going to be your channel for the rest of your life. You're an innovator, and you're gifted in that way, and not many people are like it. But you see a need, and you understand there's a different way to look at this, and I think people are going to respond well to it because it's going to be evidence-based, well thought through, and you can sell anything with passion, and I think that's very exciting. To sell ideas with passion and integrity, that's something unusual.
I'm flattered, and I appreciate that. I mean, I chose this because I saw the opportunity, because what I saw, which has only been so much more reinforced and expanded upon the more of your papers that I read. But what I saw originally was there was opportunity here that you have one asset, which should be valued the same in any package, valued wildly differently.
Oh yeah.
So I've got real estate in a public fund, real estate in a private fund, real estate on the market as private real estate, and each have a completely different risk profile. And a lot of people being very dismissive about the category in the asset class, where there's really very little innovation happening, but a lot of opportunity, a lot of room to do things smarter and better. Not a lot of people that have really been thinking along those lines over the last 20 years, but it's a massive asset class. And, I think if we could take some of the principles that you've been working on, some of the principles that you've developed, we've got our own proprietary AI models from some of the leading AI developers in the world. We've got, the probably the best data set that's ever been put together for REITs and for MSAs by geography and for public REITs that's ever been put together. And, it's really on us to figure out how to package that up into, products that are beneficial to public market investors, right? And, I don't know if we've done that yet, but we're working on it and we'll get there. And, having people like you on our team is tremendously valuable. So I want to thank you for your work, for your mentorship, and for your help. I didn't say so from the beginning, but Randy is working with us at Armada on a number of concepts. So thank you for your help with that. I want to leave off with one last question here. you started early in real estate working. We talked about Goldman and Nomura, but some of the earliest groups and biggest and most influential banks. And then you've advised some family offices, and you've worked with like 50 pension funds. I think you were part of $6 billion of deals. What story do you want to tell from the old days that can, be instructive to where we are at this stage in the cycle?
There was a economics professor at Harvard. His name was Schumpeter, and he was Austrian, and he came over during the Holocaust, and he wrote a book called Creative Destruction, and it was a book about capitalism. And I've been thinking a lot about capitalism, particularly as it relates to liberal democracy and the current threats to our democratic institutions. But I think about it a lot. And if you think about creative destruction, the way capitalism works in its refined forms, innovations occur, and old businesses, old concepts get destroyed. And I think creative destruction is a positive thing because it refreshes the market, and it creates a dynamic market. And the reason why liberal democracy, and I use that with a small L, liberal democracy is important, because liberal democracy and markets are like yin and yang. One can't exist without the other. And it was because of the rise of capitalism during the industrial period into the 20th century, where people's relationship to the economy was very different than if you were a serf or a peasant, and your relationship to the Lord or to the head of the manor. And so things have changed politically, economically. The structure has changed, and I think that the fuel for this, the fertilizer, is innovation. And so I've always, I haven't been a Slavic acolyte of change just for change's sake, but I do believe that the real estate sector has lagged behind the other capital market sectors, both in terms of its introduction of new ideas and its receptivity. Now, having said that, it's changed, because when I left teaching at Princeton in the early 80s, and I went to I was a partner at Jones Lang Whitman before it became Jones Lang LaSalle, and it was a British firm. I was walking down Park Avenue, and a partner said to me, he said, "Randy, I wrote one of the first lease by lease analysis programs in PL1, I would say." And he said, "Randy," he said, "you always make things more complicated." He said, "I can take any of these buildings on Park Avenue," and he says, "just tell me what the NOI is, and I have the cap rate, and I can tell you what the value is." I said, "So your value added is division?" well, he was like out of central casting, British. He was more British than the Queen. And so I remember that clearly, because in the 70s, people were still using slide rules and things like that, and cap rates and whatever. But what I tried to point out to him, and I try to point out to people now, that leases are like bond substitutes. Leases are substitutes for debt. And what's interesting is that if you take two buildings back to back, same location essentially, same physicality, same vintage and everything, but different lease structures, they can have radically different values. And so people need to understand that. So come to the present. I do a lot of stuff applying Monte Carlo to highly structured deals. And somebody said to me, "Oh, you're just introducing new assumptions." I said, "Au contraire." I say, "No, I'm not. I'm making hidden assumptions visible." And I explain that, with my lease example and a few other things. And so one of the things that I like to do, and I get a lot of kick out of it, I like to see the scales fall from people's eyes. I like to motivate them, make them excited, and help them create value. And that, to me, is a good day if I can do that.
Beautiful. That's a perfect place to leave it. Thank you so much, Randy, for joining the podcast.
My pleasure.
Thank you to the audience for your time and attention. If you want to hear more of these podcasts, let me know. We're going to be putting them up. And again, more REIT conversations on Twitter Spaces, and we'll be back soon.
Thank you for listening to the Phil Bach Podcast. If you enjoyed the show, please take a moment to drop a review. This show was published for entertainment purposes only and is not investment advice. Please contact a licensed professional before making any investments. Some of the securities discussed on the show may be owned by its participants. Opinions expressed on the show may not reflect those of their employers. Stay hungry and stay foolish.